Hello everyone, my name is Shailesh and welcome to Financial Statement Analysis series by Finacle Shah Classes. In this pilot episode, let me begin with explaining why we have launched this series, and then we'll follow up with the training content. In your graduation curriculum, as well as, let's say, professional certification programs, you may have studied or rather gathered a theoretical understanding of financial statements. What exactly is a balance sheet, income statement, cash flow statement, and likewise. And the way you are tested in these graduation or professional certification programs is they'll give you a lot of data and you will have to calculate certain ratios and interpret those ratios and likewise. Now, these candidates who clear these programs or graduation content face a lot of issues when they hit reality or hit the ground when they have to actually analyze a live listed Indian company. This is on back of multiple reasons. First, everything was provided as given information when you were solving questions. However, when you hit the reality, you have to learn the art of extracting data in the first place. Now, a lot of people don't even know where to source the data, what kind of qualitative, quantitative data has to be sourced for a particular company. Which sources it needs to be taken a look at: the company filings, the investor presentations, con call transcripts, and likewise other sources. And the second reason why people struggle is what they would have studied is majorly from global perspective, but they have never really actually applied it to an Indian accounting standards perspective and opened a listed Indian company's annual reports during their graduation or any other training tenure. Precisely with that intent to enable a fresher who is willing to and very much passionate of building a career in investment domain, this skill set is very much needed. And with that intent, we have launched this financial statement analysis series. We strongly believe that financial statement analysis series is a three-step process. First, an analyst needs to learn how to extract data. Second, understand the extracted data first. And then third, use that data and analyze it, connecting it to the business. Precisely these three steps will make you a very good, decent analyst, at least to begin your career with in the investment domain. In the series of financial statement analysis, upcoming episodes, what we plan to give out is a live listed Indian company's case study training perspective, like when you learn a concept, learn how to apply it to a listed Indian company. Proceed with these three steps: extracting, understanding, and analyzing the data, and then connect it to the business. We want to give out a practical training perspective to each and every candidate who's listening to this video based on our experiences after having worked in the investment domain for over a decade. What we have done is we have collated this wonderful content from our own learnings, from our own struggles, and we have tried to collate this content and pen it down for you. This video series will walk you through with understanding and extracting data of each and every line item on all the financial statements, which is where you genuinely understand what financial statement analysis means. All right, so with that intent, let's get started with the first pilot episode of our series. Hopefully you guys like it. By the way, you can follow us on our Instagram handle, Facebook, as well as YouTube to gather more such content, as well as you can refer to our website, finacleshahclasses.com. On the forum section, you'll find some really decent written material, which I'm referring to on the screen right now. All right, so let's get started with the first line item, which is revenue. As you may already know it by the names of turnover, total sales, or as a matter of fact, even sometimes referred to as total income. Now, why is it so important that we should focus on revenue? Because revenue is only the single way for a business to generate cash to fuel its operations or even grow in future at a sustainable rate. A business is usually valued based on the amount of earning potential it has. Now, these earnings are directly driven by revenue, so which is why revenue drives valuations. And hence, it's really important for every analyst to understand revenue. Now, often a lot of, a prominent indicator of a growing business, which is taken, one of the prominent indicators which is taken is revenue growth rate. When you take a look at a growing business, you often take a look at what kind of or at what rate revenue is growing. So before we get to the final outcomes, let's first understand, remember the 3 steps of financial statement analysis. The first step is extracting the data. So let me first explain how do you extract revenue data from financial statements. Now, when it comes to financial statements, let me just quickly take one simple case study at point here and walk you through. Now, the case study which I've taken is Hindustan Unilever Limited. I'm sure all of you may have heard of it business. Now, you can extract revenue data from set of financial statements. Now, in annual reports, you will find generally two sets of financial statements. One would be standalone and second would be consolidated. Now, as you can see, let me just quickly browse you through so that you get a fair understanding. This is annual report 2021 by the way of Hindustan Unilever Limited. On page number 65, you will see standalone financial statements of Hindustan Unilever Limited. This is standalone balance sheet. As you can see, assets, liabilities, and equities, followed by standalone P&L statement, which is statement of profit and loss, or also known as statement of operations or income statement, followed by statement of changes of equity, as well as a cash flow statement. Now, similar set of financial figures are available for consolidated as well, which is there on page number 104. Now, you may wonder what exactly is the difference between standalone and consolidated, something which we will be covering in the next video series. But for now, let's take by default all the figures from consolidated. Both financial statements of standalone and consolidated are used for analysis perspective. But like I said, hold on to that for now, because we will be first understanding what's the difference between both of them afterwards. But for now, as a default, let's just refer to only consolidated figures. When you take a look at the consolidated statements, you will be able to extract revenue figures from income statement. When you take a look at income statement, let me zoom in a bit so that viewers of this video can benefit and can actually read the content on the screen. As you can see, the income statement is usually presented in this fashion, starting with revenue. Now, when you see this would be the revenue figures. The numbers are obviously in crores, as mentioned here. You will see the latest year here and the comparable year here. When you take a look at this, you will see it to be of two parts. One is revenue from operations and second one is other revenue. Now, you may wonder what the company means by revenue from operations and what exactly falls under revenue from operations. That would be in note 24. This is the most important part of financial statement analysis. Had there been no notes, financial statement analysis wouldn't have been possible. So, which is where it's really important for analysts to learn how to read these footnotes. Now, these are often known as notes or footnotes for any annual, or rather quarterly financial statements. Now, when it comes to these footnotes, they are usually provided in India on an annual basis. For you to understand what falls under revenue from operations, you need to take a look at footnote number 24 and 25. For your reference, so that the reconciliation of figures makes sense, I'm just going to write it down here. 47028 is revenue from operations, so I'm just going to write it as ROP, and then there is other income of nearly 410 crores. So yeah, pardon me for the bad handwriting. I'm trying to do a decent job at it. All right, now we need to open these footnotes. Now, where are these footnotes available? If you scroll down below the financial statements, the footnotes data is usually available. And for that, we need to take a look at the footnote numbers which are mentioned here. So note number 24 and 25 are actually available on page number 121 of Hindustan Unilever Limited. I've taken down those numbers so that I use your time on this video very efficiently. By the way, you can apply these things on your own as well. Now, let me just quickly scroll down. Yeah, you can see note number 24 here, revenue from operation. Now, remember the number which we sourced from income statement was 47028, and you can see this total to be matching to that number. And these are sub items rolling up to that 47028 crore figures. Now, let's understand what these items are. Sorry. Let's understand what these items are one by one. Sale of products, sale of services. As you can see, Hindustan Unilever Limited is selling products and how much revenue it's generating from them, and services. Then there's something which is known as other operating revenue with a condition supply. Now, you can see this condition supply to be mentioned here. We'll take a look at that as well. But Other operating revenue falls around, three buckets. Now, these natures are income from services rendered, makes sense. What exactly is operating revenue? One might wonder. Operating revenue is basically revenue generated from core business activities. Like Hindustan Unilever Limited is into manufacturing of a lot of products and selling it out there under different brands. Now that is their core operating figure. When you take a look at other operating revenues, you will also find commission income on consignment sales. Moreover, you'll find government grants, scrap sales, and export. Now you may wonder why government grant is actually operating revenue. Shouldn't it be a non-operating thing? Because government grant is something which is given off by government, sometimes maybe one-off, or as a matter of fact, on a recurring activity as well. If you're generating it, it's not something which business is actually doing an activity. However, the reason why often government grants or export incentives or even sales tax incentives are classified as operating revenue is because the government is incentivizing these businesses because of their operations. What kind of domain they are operating in, and precisely why they are receiving those subsidies. So any kind of grants or incentives or subsidies provided by government to the businesses are mainly because of their core business operations. Hence, that is actually included in revenue from operations. Now, precisely what you see here is a total of 47028. Now, you may wonder, how did this number come? How is it that we got this figure 47028? Now, to understand how a revenue is computed, you can take a look at the accounting policies of financial statements. Remember, accounting policies are present just below the financial statement. So when we saw the consolidated figures on page number 104, let me just quickly walk you through. On page number 104, when we saw the consolidated figures, when you scroll down, let me zoom out a bit so that the scrolling is easier. When you scroll down just below the financial statements, you will see accounting policies. Now, these are basically accounting policies explaining what they have done and why they have done and how is it that they have calculated each and every. So what particular line item on financial statement represents and how is it calculated is present here in accounting policies section. Now, when you refer to page number, let's say 71, which is again similar accounting policies which are present for standalone, you will see revenue recognition paragraph, which is same for standalone and consolidated in this case of Hindustan Unilever Limited, which is why I went to standalone. Now, when you see, you will see a paragraph here. Let me actually zoom in a bit so that it's, readable for users. Now, when you see this, you will see revenue is actually calculated based on contracted price after deduction of any trade discounts, volume rebates, any taxes or duties collected on behalf of government, such as GST. Let me explain the statement. Believe me, this is genuinely very important. Revenue figures. So imagine that, let's say, if HUL is selling a soap at 100 rupees MRP, and I don't know, maybe there is, let's say, a 5% GST applicable to that. In this MRP of 100 rupees, they have collected a 5 rupees GST, which, by the way, is not their revenue because they are basically a collection agents on behalf of government. That's the beauty of indirect taxes. So, different companies are collecting taxes on behalf of government and then eventually filing it to the government, paying it back to the government. So when HUL is actually charging you 100, they may be getting 100 rupees cash, but out of that 100, they have to pay 5 rupees to the government, assuming, let's say, 5 rupees was the GST. So 100 is revenue, MRP, this is basically the contracted price, 5 rupees would be GST. And let's say if there is a customer who comes, on a regular basis, and maybe you would want to, offer a lucrative price and he or she asks for a discount, that would be the trade discount. Volume rebates are basically if, often people tend to buy in huge volumes, and to incentivize them to keep on a recurring basis buying from the company may choose to offer certain discounts. That would be volume discounts or volume rebates. So let's say if there was a 2 rupees volume rebate, so technically speaking, the revenue which is reported on the income statement, the 47028 figure which we saw, is corresponding to this 93 figure. So this is what is reported on income statement as a revenue under new accounting standards. Now, you need to verify how a business is computing revenue by taking a look at the accounting policies. This revenue recognition, we'll study more on what this is in the upcoming series. But for now, you only need to refer to this paragraph to understand how a revenue is actually calculated. Now, let me move back to the footnote of revenues on page number 121. There's one more thing which I want to talk about. Now, when we refer to the revenue from operations, the ROP figure, which was 47028, precisely the same breakup is available just below that footnote. Now, this is a mandatory footnote under new accounting standards for each and every business to provide the aggregation or the breakup or reconciliation of contracted price with the reported revenue. So let's say this was precisely the MRP figures, and the deducted amount would be either GST collected on behalf of government and either trade discounts or volume discounts, etc. And then comes your sale of products. So what you see here, 46321. Now you may wonder, why is it not matching with 47028? Let me explain. Remember, this 46321 is for goods and services. It's not other operating revenue, which you see here. So if you add these two together, you will get this number. And these would be the other operating figures which are added. So for every analyst to understand how do you calculate total revenue from operations, a total revenue from operations is actually calculated as operating revenue, which is sale of products and services, plus other operating revenue, which would be this section. So please understand, in terms of revenue figures, it can be broken down into three aspects. One is operating revenue, second is other operating revenue, and then would be other income. So remember, the difference is these two are operating in nature. The other income is non-operating in nature. Now you may ask this question, or you may actually face this query: what exactly is other operating income, and what was the figure? Now let me just quickly toggle back to the income statement which we saw, and we will take a look at the other income figure. I had written it down, but because I had to clear the screen, let me just quickly toggle it back. So 105 page number was income statement. So you see this other income footnote of 25, which is of 410 figures, 410 crores. Let's just quickly browse back to that footnote 25, once again present on page number 121. Now, when you open this 121, you will see on the right hand side, let me just scroll right, you will see note number 25, other income. In this other income, just observe the nature of line items. So interest income. Why is interest income considered other income? Now, a lot of businesses may have excess cash at their hands, and they may be parking their money with liquid mutual funds or some other schemes or investment opportunities where they feel. However, since it's not really a banking firm or an NBFC operating in a banking sector, the income which they are generating is technically a non-core operating income. Hence, it's often clubbed under other income, which is termed as other non-operating income as well. So as you can see, bank deposits, current investments, and others are basically, these are interest income which the business may have generated. More, or there could also be dividend income, because let's say if you have invested in shares of other companies and you actually receive dividends, that is also non-operating in nature. Unless you are, let's say, a holding company like Berkshire Hathaway, then perhaps investing makes sense. That would be your core operations. But in case of HUL, this becomes a non-core operating activity. Hence, dividend income is a non-core operating or a non-operating income. Moreover, there are other non-operating incomes as well here, which is fair value gain on investments. Now, you may not understand this as of now, but we will be covering this line item in our next video series. So stay tuned for that. Moreover, you will also see sale of investments. Remember, these are investments and not, technically speaking, scrap sales. So which is why, investments are considered non-operating in nature. Now, let me just quickly cover why scrap sales are actually considered operating in nature. A business often tends to recycle their assets. A new asset is coming, and every time you sell the old assets, it's part of the core operations only, because you tend to recycle your assets for the operating activities, which is why scrap sales are often considered operating income. Now, you may think, is this usually the presentation for all businesses? Is this how actually all businesses see the presentation to be? So let me just quickly browse back to 105, which was income statement. So this was a presentation for most of the business. However, the presentation can vary across business to business. So let's say if I open ICICI annual report income statement, which you have in front of your screen, by the way, you will see the presentation of income statement has changed. So depending on industry to industry, the presentation may change. So interest income, as you can see, this is a banking industry. So your precise core activities are lending. So the interest which you generate are operating income in nature. So which is why interest earned is basically revenue from operations. So What you see here is, connecting how business works, and the figures are accordingly tied back to them. So this is precisely in terms of understanding how the presentation of income statement is done. There are a couple more points here. Let me just quickly sum it up. Now, in terms of non-operating items, often you may see, sorry, in terms of non-operating item, you may often see line items like interest income, dividend income, something which we have seen. In terms of operating income, sorry, you may see a line item called claims received. Now, often businesses tend to ensure their ongoing operations. So if something goes wrong, they may receive that claim back, which is why it's actually termed as operating income, because it's an ongoing activity for the business as part of the core operations. In terms of financial statements, please be very careful in what line items you see in operating income and non-operating income. So the presentation which you see here, an analyst should go and verify in footnotes whether those line items are generally operational in nature and not. Precisely brings us to the point, should we consider what line items the business has mentioned to be directly operating in nature? No. And why is that? We'll take a couple of case studies in the next video, so stay tuned. If you like this video, please do subscribe. Moreover, comment in case if you have any questions. You can also visit the written content on our forum. In case if you're an avid reader, you will really enjoy it with the screenshots which we have placed, precisely the same content which I walked you through in this video. For people who also like more educative content, you can follow us on Instagram. You'll find more details, reels, and entertaining content there around current awareness, valuation series, business analysis series, also on YouTube. Thank you so much for your time. I hope you guys liked this video. Do let us know in case if you have any questions. Bye.